Have you guys heard CMHC is allowing you to refinance your house? You heard that right. For the first time in a long time, CMHC is allowing you to refinance your house to build an accessory dwelling unit. In this video, we're going to break down exactly what that means, if it's going to work in Canada, and how does this affect your ability to be able to increase the density in your home. Hey guys, what's going on? Josh and Aaron back for another Finance Friday. And in today's video, we're going to chat a little bit about, you guessed it, some CMHC rules that just came out, but it actually affects residential homeowners. What's happened is CMHC is now allowing for an insured refinance, which we haven't seen in the industry, at least since we've been in the industry. It's been quite some time.
Yeah, now being January 15th, 2025, not specifically today, but that will be coming into effect. Obviously, it's exciting. It's going to create some stir. It's going to be very interesting to see how applicable it is and if it actually works out in terms of borrowers being able to, afford the refinance here. Unfortunately, unlike a commercial loan, the insured residential stuff up to 4 units, you're still qualifying on your own personal income. Unfortunately, it's going to be interesting to see, how this actually kind of plays out in terms of the affordability from a personal debt servicing standpoint. Unlike CMHC commercial mortgages, this is going to be based, off of your own personal incomes and debt servicing, which means we are still subject to the insured qualifications for the lenders, which means, more limited income usage from the rental income. Most likely you're going to be around 50% of that rental income. Personal GDS, TDS scores, because it is insured, you're going to be maxed out at 3944. And you're going to be having to qualify with your insurance premium on top of that as well, too. You're going to get the 30-year AM this time instead of, being stuck at a 25-year AM, which is, it's going to help. But, I think when you take a look at, like, a step back, and you take a look at the insured market and home buyers today, and, in terms of this product being up for properties up to, just below 2 million, 1.9999, who's really going to be able to afford this from a personal debt servicing, even with, 3 additional units, one of them having to be rented out by, yourself or a son, daughter, relative. Some sort of like close member of kin. It's going to be interesting to see how this actually, works out and what the affordability actually is for a lot of these guys. Unfortunately, for business for self individuals, you're probably not going to be able to qualify for this loan because it is going to be based off your tax proven income. And, we know everyone likes to write down their income. So it's going to be interesting to see really how it does work.
Absolutely. Let's dive into the product itself. We'll talk a little bit about how it works, why it is maybe introduced, and then why we think it might work, and then why we think it's not going to work. So product itself, as many of you know, increased densification is a massive topic. The election's coming up. Nobody can afford homes. The government's like, we got to create more housing. And I think this might be a little bit of like a more political play than anything, but the product specifically is intended to allow for an insured mortgage for people who are looking to increase the densification of their home. Either add a laneway suite, add a garden suite, add a basement suite, add a secondary suite. Essentially using the current asset you have and increasing that in a way. Now, if you haven't watched this before, federal government came out and now allows for 4 units in most places across the country, and municipally it changes between 4 and 5. So you don't have to rezone anymore. You can essentially now, if you have equity in your property, refinance up to 90% of the as complete value of the project with an insurance premium. So it's an insured mortgage with CMHC. Important to note, there isn't direct guidance from lenders yet on this product. So what we're doing is we're talking about the specifics around what was released the other day. And as things come out, we'll let you guys know more about it. But we have a 30-year AM available now. Same debt servicing ratios as we once had. So 3944, as long as you have a decent credit score. Essentially anywhere that CMHC will finance, correct?
Yeah, I mean, loan size under 2 mil, can't be at that. It's similar to how it was previously with insured deals and nothing above $1 million. So I mean, your cap is essentially 1.999 million, and then has to be rented out leases, no short-term rentals. So obviously no Airbnb, Verb, stuff like that. Yeah, I mean the big thing here is going to be, again, just how viable is it. and then also in terms of like the actual construction piece, still waiting on a little bit of clarification as if this is going to be similar to the current purchase plus improvements, where on the initial loan, you're qualifying for the entire loan on the back end, but you actually have to go through and do the renovations and the construction yourself. And then the lender will reimburse that back to you. So kind of waiting on a little bit of clarification there. Obviously, if that is the case, again, we're taking a look at some secondary factors that are probably going to impact a lot of individuals in a market, similar to today or not similar, but the market we are in today where the liquidity is tight. What kind of regulations is going to be around accessing equity in a household to be able to, get the actual funds to be able to do this? Are you going to be able to, put a secondary mortgage on your property, a second mortgage, pull it up to 90% or 85%, knowing that you're going to get that 90% on the back end, take advantage of the equity to be able to put that towards it? Or is it going to have to come from, your own cash savings? So I mean, it's going to be interesting to see kind of some of the nuances around it, and if there are any sort of limitations or guidelines that they're putting on there in terms of where the money has to come from. So some stuff that we're still waiting on, and we'll figure out moving forwards. But overall, obviously, I think it, if it works out, I think it is a bit of an exciting product. But as you said, it could very well be a little bit of a, a little too late from the Liberals trying to save some votes moving into the election.
Yeah, I mean, if you truly do, if it's purchase plus kind of vibe, and you truly have to outlay the capital first, it's a big nothing burger of a product because people need the money to be able to do the project. So, I mean, to make it really viable, it has to be kind of like a construction loan. It's going to have to be, progress draws, and if that's the case, many of the lenders who are actually facilitating insured mortgages right now aren't set up to deal with, progress draws and construction loans and stuff like that. It's going to be interesting to see how the current lending environment is going to have to adapt to this product, because it's very different than any product that's on the market right now. It poses challenges on both sides. It poses challenges to the fact that, most Canadians don't have the capital to do these projects, especially if you're talking about, a brand new structure, a few $100,000 in the GTA to do this. There's a reason why you're limited on the purchase plus, because people even have a hard time getting the $40,000-$50,000 to do the renos, nevertheless fronting the construction up front. I think it's a great idea, and I think that as we continue to progress through the rest of this year and then coming into next year, we're going to have more clarity on it, obviously, but step in the right direction if it is something that truly allows somebody to access their equity. But taking a look at the viability of it, so if they're going to offer you a percentage of your as complete value, so what it says is 90% of the as complete value, is there any other way that they'd be able to do it other than a construction draw mortgage? Like, no lender is going to give capital above 100% of the current value of the asset. Like, that is impossible in the eyes of a lender. They're over leveraged. It's going to have to be some sort of progress draw.
Yeah, I mean, if you read the wording of it, it says that the proceeds can't, be greater than what the actual budget is. So again, I think at the end of the day, it's, I don't know. I mean, I think if you take a look at CMHC, we can only just go based off their past performance, and on the res side, the insured stuff, it is done with you having to front the cost. I think we can only assume that that's how it's going to be moving forwards, where you have to, you can apply for the refinance. Maybe you get up to a certain amount from day one advanced to you, and then the remainder of that difference is again advanced after you brought the invoices back to the lender and they advance that back over to you. But again, I mean, regardless of kind of the structuring, again, I think the big thing is going to be just the qualification from a borrower standpoint. Are we going to see something where, in terms of like loans being portable and individuals who don't necessarily have the capital, you're going to have guys that are going to go out, build it, get into the insured loan. Can you port these over? Are they going to be assumable? Like, is there going to be some sort of play there where, owner occupied guys are kind of building out these fourplexes and selling them as completed with that assumable loan in there? I mean, that might kind of help on the front end in terms of having to come up with the actual capital to get it done, but that doesn't necessarily solve the affordability issue standpoint from that obviously being an issue. So yeah, again, I think somewhat exciting in terms of the possibilities of it and what it's going to do. I think again, big thing, just affordability, and is it actually gonna be viable?
Yeah, I mean, realistically, up until this new change, The average person isn't taking on a $950,000 or $900,000 insured mortgage. The income isn't there to be able to service it. If people are looking, first-time home buyers specifically are looking to do this, very few applicants can qualify for the level of debt that they're talking about. $2 million. Even if you could, let's say, add 50% of the rental income for the hypothetical units, it'd be very challenging to be able to do that. Or you're talking about a massive construction project and it works out. It's very much switching the dynamic of a first-time home buyer to an investor level mindset, like trying to figure out a way to be able to increase that density. Like, again, so many questions. Like, can you do it right off the bat? Will they give it to you on the purchase so you can add that, or is it only going to be a refinance initially after you have X amount of equity? And how much equity do you need to have? It's going to be an interesting project.
Yeah, you'd think if they're doing it as like a refinance project, they would also consider it from a purchase project. Like, if you're purchasing a project, for the purpose of living in there and building out 3 additional units, why would they exclude that versus having it as a refinance? I'm not sure. And maybe it does come to light that they are going to allow that. It's obviously they have the purchase plus improvements, but this is obviously a little bit larger in terms of the dollar size that they're allowing for. Could also be an interesting thing to see if people start taking advantages in certain areas, like, in Toronto, where you can have a fourplex plus a laneway suite. Like, is this a potentially an easier way to get into a commercial loan where you're kind of it's tougher to kind of get these fourplex construction draws? Is this a way to kind of bridge that gap where you have an owner occupied property that, you want to turn into more of a commercial type loan situation, and you build it out to a 4 unit, and then, maybe a year later you're adding that 5th unit on the back, and
Wrap it all
now
up.
you can value the entire project as a commercial loan and exit into, commercial CMHC. I mean, obviously, we don't really know the limitations of it until we really start trying to submit these deals and get the projects done. But, if we know anything about real estate investors, they're definitely going to find any sort of create a loophole that, that is there with the product. And I'm sure we'll know very quickly what the limitations are and are not with this product once it comes into effect in January.
Yeah, it's if there's a will, there's a way. The product as a whole, from a qualification perspective, I think is obviously going to have challenges. It looks as though there's some new products also coming out with that secondary suite program that's going to be rolling out. I think it allows you to have or to borrow up to $40,000 with very cheap money. They didn't give exact cost, but very decently cheap capital for people to access. It's going to be interesting to see why somebody would choose one over the other, and how that's going to be, I guess, registered on title, and what that's going to look at, or just what the appetite in general is for the population to do this. It doesn't seem like the average Canadian wants to chop up their house and add additional units. Like, at what point is this going to become like a norm? Is this first-time home buyers and their only way to get into a property and the only way to hold this stuff? Or is this more for, your parents have a house and they can't afford to live somewhere else, so you build an ADU in the back and they live there for multi-generational families? Like, it's going to be interesting to see how, or what demographic or what group of Canadians really start grab onto this, and how much this is actually going to affect the population.
Yeah, I think another, a big thing is going to be, obviously, you're only getting the refinance if the value is there, coming out of a market where there hasn't been a whole lot of transactions, especially on the larger res multifamily stuff, the 3 to 4 unit. Other comps even going to be there to help support. We don't typically see lenders on the res side taking cost approaches, income approaches. It really is based off of a comp-based approach on the value. Over the last few years, there really haven't been a whole lot of 3 unit, 4 unit buildings moving around. Like, I know some of the clients that I've worked with have had issues, especially in the GTA, trying to get the values there, projects being valued on, other comps where not every single unit was legal and theirs all are, and trying to get the value there. So, I think in terms of this project only really works if you can get all your money back. And, if you can't quite get the full refinance based on not enough comps in the area, again, is that going to create issues with the viability of it? And in certain markets, is it going to be more viable? Is it not going to be more viable? Obviously, that's going to be something to see. If more and more people are getting into these conversions, obviously that will help to kind of create that comp market. But there kind of has to be some comparables there to give that value, from the get-go to be able to make this project work.
Yeah, comps have been the most challenging, especially on the residential side. You know, when you have a market that swings 30%, really challenging to kind of set like an as complete value and then make sure the numbers are going to work. I mean, we need a stable market, a normal market to really make this work. Appraisers are going to have a heyday trying to figure this out in secondary markets. I think it's going to be a little bit of a challenge, but overall, I think it's a fundamental shift in regular like big five bank mentality and mindset. You know, if anybody's ever tried to get an ADU financed, it's legitimately impossible. And not because the banks won't do it, but because the comps are very difficult to come by. A lot of appraisers will see an outside building that is not attached to a property as an outbuilding and won't provide it value. Historically, what we've done is use small commercial financing to be able to take a look at an income approach as well as a capitalization approach or a direct comparison approach, sorry, to be able to determine the value. And then we use the net income to service that debt. And you're able to qualify with that. It makes sense for investors still, but most big banks won't take an outbuilding as value, which causes challenges because you spend all this money on this accessory dwelling unit and it doesn't work anymore. So some policy is going to have to change from the top down or from the appraiser's view to be able to really capture what this product is looking to do.
Yeah, I think if you read the wording of it, like it has to be, I don't think they're considering garden type suites for this. I think it's like it has to be, I mean, the rules are it has to be a fully legal. So no, hot plate in the basement. Like it's got to be full kitchen, full bath, complete, self-contained, separate entrances and stuff like that. So I think it's gonna have to be all attached. So, but I mean, yeah, to your point, like, the values there are hard enough to come by. And I think it's gonna be interesting too, like, there are all these investors that are doing like tear downs and stuff and building up 8 units and whatnot. There's already this huge like NIMBY mentality. Like, are we going to see any sort of shift now? Like, now that the NIMBYs have access to this on their own primary residence, like, is it going to change their opinions a little bit? Are they going to start to kind of go down towards this? Or are they going to put up just as big of a fight for regular homeowners that are doing this with their own owner occupied properties, not not just the the tear downs and infill stuff. So it's just funny that there's already that pushback, and this is kind of a product that's geared towards those individuals who are already pushing back. And fourplex realistically isn't that far off of what a lot of these investors are doing, considering they're doing 4x4 or like side by side fourplexes, which is the only difference is on one lot instead of there being the side by side. So it's going to be.
You're about to see a homeowner association take a whole new meaning. Yeah. Like for all these nicer places or nicer areas, there's probably going to be homeowner associations that are going to ban this. Like, realistically, if someone's throwing a fourplex up beside me and chopping up their house, house value is a real thing. And there's just people who most definitely are going to have a challenge with this. I think I saw something in the GTA where there was they were building garden suites behind this new development, and the new development was pushing city council to actually not allow for the garden suites because their backyard was abutting up to where this guy's front yard was going to be. It was a big mess, and I don't necessarily think that the city or the people who are making policy are necessarily thinking about how it's going to affect that. But I guess you're stuck between a rock and a hard place. You need density, and nobody's willing to cut the check or cut the tape fast enough to be able to make the density happen. You have to let the average Canadian make it happen, or are they doing it because they can't have house values drop? Like I think Trudeau said it himself. We can't have house values drop. It's a whole nother conversation about the REITs and the pension funds that are invested in the housing to keep the value high, but. Yeah, the whole HOA NIMBY thing, I don't think it's the last time we're going to talk about it. I think that we're definitely going down a route of once this kind of spreads and becomes mainstream, are there going to be places in certain municipalities or cities that aren't going to allow this anymore?
I think the goal now is get your family members to buy side-by-side lots, get them out to be 4 units each, and then, just down the road, you take the whole thing into one big commercial loan. You got 8 to 12 units now. You and your family are now into the development space. I think, that's the new way forward.
Yeah, 2 brothers side by side.
Yeah,
build
just get
it
the
out.
whole family, get everyone on the entire street. Like I think it's going to be interesting to see how people start to kind of use this. And again, like, what are the loopholes? What are the regulations around there? Are you going to be able to do this with multiple different properties, all which insurers. I don't know if it spoke about which insurers are all taking a look. I mean, I'm assuming this is going to be all three insurers. So, our individual is going to be, taking advantage of the fact that you can have more than one insured home, because this isn't what it sounds like to be a first-time home buyer thing. This is just an insured mortgage thing.
What's even crazier is most insured mortgages up until today were owner-occupied insured mortgages. Now, this specifically outlines family member or close relative has to also live in this property, which
Yeah.
doesn't even mean you have to live in this property, which is kind of wild.
Yep. There might be some student rentals that are created out of this product as your child
Not
goes
that
off
we
to
condone that
university.
in any way whatsoever.
No, it has
Absolutely
to
not.
be
Yeah,
conforming
owner-occupied.
100%.
That's correct.
No, I agree. I mean, again, wording is one thing, where the lenders and the regulatory bodies come back and what actually happens on the submissions and the underwriting. Because they're insured, it's going to be interesting to see like how the lenders are using their rental income again. Like, at 50%, if they are only just doing an add back, at the end of the day, like, yeah, it helps. But again, with the affordability being the biggest issue, like what is that going to do? You have to qualify with the insurance premium on top. You're gonna have the sales tax on top of this as well. Again, I think, maybe one of those, just like those resorts where the government's kind of throwing something out there to kind of appease the people. But, I mean, we've seen in the past where, there's been products that put out, the first time home buyers incentive programs. That was a complete bust. Nobody used that program. No one could qualify for it. Sounded great, but like the number of successful projects was, I don't even know, like minimum. Like,
Same with the fractional ownership program
yeah.
where they were providing equity in form of down payment so you could get in. Like nobody, I don't think I ever did a single one of those.
I mean, I think if you want to take a look at like how much they're forecasting the success, you would take a look at like how much money they're putting into a program, and it's just over 400 million over 4 years.
460 million. Yeah, that's like 1,600 ADUs.
Yeah,
It's not a lot.
yeah. So how much, the viability of the long term here. I mean, if they're only throwing that much money in there, again, is it a thing of just they're just test piloting it and they want to see how many projects actually come out of it, or again, are they just kind of putting a little bit of money aside, knowing that it's really not going to be an overly used product, and hey, we put it out there, but it's not the government's fault. People can't afford to qualify for homes, right? So interesting for sure.
Yeah, absolutely. Currently, right now, there isn't specific guidance from any major lenders. Information came out a few days ago. As information does come out, obviously, we'll share it with you guys. We'll let you know how it's going to work and how it's going to be rolled out. Until right now, obviously some of this was just factual based off the information that was provided, but some of it is guesswork, a lot like the the tranches and how it's going to work. But it's important to understand that as we go through very turbulent or interesting times, there's a shift right now in the economy. There's a shift. Back when I was a kid, people were talking about, the middle class is shrinking, and, you'd hear it and you're like, yeah, whatever. The last 3 years, it's very, very apparent that middle class is shrinking. And, as that shifts, I think you see investors and developers and people who are purchasing real estate, they're going to shift with a tide, and that's increased densification, that's infill with multifamily, that's understanding the commercial development projects and products that you can take on. I always say the money is in the money. It's understanding the products and the services that are provided and how that debt works to allow you to continue to move forward. We're not in Kansas anymore, to say the least. Like, things are changing, and they're changing quickly. So for anybody who's watching this right now, obviously you guys care about policy, and you care about how these things are going to affect your ability to be able to create wealth in Canada. So just keep up to date on those things, because I feel like Erin and I don't even have to figure out what we're shooting anymore. Every single time we shoot, we essentially just take a look at the new policy changes that are coming into effect to give you guys an update. So it's never been more relevant than right now to understand exactly how these products are changing and how our market is changing to allow you to be in the right situation to continue to purchase and develop.
Yeah, and I mean, in terms of most opportune time to learn, I mean, you're quite living through that like learning process, right? Understanding just how the Fed updates impact Canadian rates and the economies, right? Every time there's a job market coming up from the States, like getting it like quickly on the commercial side, but like, are we gonna start seeing more people start to lock in these rates a little bit quicker? If you're a month out from funding or a few weeks out from funding, and there's a job report update coming from the States, maybe we just start seeing people locking into these rates just in expectation, kind of what we just saw. Like there was like a 30, 40 point increase on the CMB. So, I mean, you're living through the best time to be able to actually learn and figure out how the economy works and moving forwards. Again, understanding that real estate works in cycles, you should be able to take everything and move that forwards and be able to become a more successful and educated investor in the long run.
Yeah, and I mean, it's you're going to continue to see these shifts. You're going to see a power shift possibly in the federal election. You're going to see different views and perceptions on how to deal with this major, real estate crisis that we're dealing with. But understand that there was opportunity in a market that was going up. There was opportunity in a market that's going down. There's opportunity in real estate that is evolving. You're not always going to see it right in front of you, but it is there. As policy shifts, keep an eye on what that means. If policy is shifting and rules are changing, it's for a reason. It's looking at the direction of where our economy is going. And I believe, and I think Aaron believes too, our economy is going towards that multifamily route. If anyone's ever been to Europe, affordability is a thing of the past. Everything is multifamily. You go to any major developed country that isn't Canada and the United States, there's multifamily everywhere. Most people live in smaller units. It's more expensive. There's a small group of people who own all the real estate. Most of the places don't even have financing options the way we do. History repeats itself, and I think Canada's moving to that place where increased densification and multifamily real estate is going to be the way to the first step to get into a piece of real estate, helping cover that debt. Fundamentally, values go up due to quantitative easing. They print more money in the market, asset values increase. Someone's sitting here waiting for the bubble to pop. Essentially, I guess that would entail the entire market no longer printing money.
Yeah, I think that pretty much wraps up everything we kind of have to say about this one. It's gonna be interesting to see. Hopefully, this does become a product that there is some viability to it. See where the rates go. See how affordability kind of maintains moving forwards. But appreciate everybody watching. If you have any comments or, we'd love to kind of hear your feedback. So definitely drop that down in the comments below. Share the video, give it a like, and stay tuned for some other videos coming out.